Okay, so you're trying to navigate the markets, make sense of the swings, and, well, make smarter decisions faster.
That's the idea.
Good, because today we're doing one of our deep dives. Think of it as a shortcut, really, to grasp a trading concept you asked us about.
Exactly. We're zeroing in on trendline breakouts, how to understand them, how to potentially capitalize, and we'll use the Nifty 50 index since that's a common interest.
Right, and our source material describes a kind of ideal scenario for buying one of these breakouts.
Yeah, so our mission here is to pull out the absolute key steps, the things you really need to watch for.
Without getting totally overwhelmed.
Precisely. Let's make this pattern usable.
Okay, let's start at the beginning. What exactly is a trend line breakout in an uptrend?
Well, basically, imagine the market's climbing overall, right? Higher highs, higher lows. That's your uptrend.
Hmm.
But sometimes it takes a breather, it dips, corrects a bit. During that correction, you might see a series of lower highs.
Okay.
If you connect those lower highs with a line, that's your descending trend line within the bigger uptrend.
Got it. Like a temporary ceiling.
Sort of, yeah. And the breakout, that's when the price pushes decisively above that descending line. It suggests the correction might be over.
And the main uptrend could be resuming.
That's the potential signal, yes. It's a shift back towards the prevailing bullish trend.
And using the Nifty 50 works well because it's active enough. You see these patterns.
Yeah, it's liquidity and volatility often make these setups quite visible. It provides good examples.
Okay, makes sense. So how do we actually spot this?
Yeah.
Step one, finding the main trend in that descending line.
Right. First, you need to confirm that broader uptrend. Look at a daily or weekly Nifty chart. Are you seeing those higher highs and higher lows?
Check. Use a chart.
Then, within that uptrend, look for the pullback or correction phase. Connect the peaks of that pullback. You need at least three, maybe four distinct points where the price touched the line and turned down.
3 or 4 touches. And charting software helps here, obviously.
Absolutely essential. And you can also use, say, a 50-day or 200-day moving average just to confirm that the underlying longer-term trend is still up.
Like a sanity check.
Exactly. Think. Maybe the Nifty ran from 21,000 up to 23,000, then pulled back, forming that nice diagonal line downwards.
Okay, setup identified. But just seeing the line isn't enough, is it? Context matters.
Hugely important. You need the broader market to be somewhat supportive. Is there positive economic news? Stable global markets? Good corporate earnings coming out? FIIs buying?
Stuff that gives the market a reason to go up anyway.
Right. And crucially, think about volatility. We talked about this, right? You generally want to avoid initiating breakouts when the India VIX is really high.
Yeah, above 20 or 22, things get choppy. More false signals. I remember you mentioning that 22.25 level back on April 14th.
Precisely. High VIX often means erratic moves, less reliable patterns, so ideally you'd see a breakout attempt when the VIX is maybe below 20, say 18, and the Nifty is comfortably above its 50-day moving average.
Got it. Low VIX, supportive backdrop. Now, the actual breakout moment. What does a good breakout look like?
You're watching for a strong bullish candle pushing through that trend line. Ideally, a solid body, maybe a 1% or 2% move on the day, with not much of a shadow on top.
Shows conviction.
Exactly. And volume. This is critical. You want to see a noticeable spike in trading volume as the price breaks the line.
Why volume?
It confirms participation. It shows lots of traders are stepping in, believing in the move. Low volume breakouts are much more likely to fail.
Okay. Big green candle, big volume spike. Anything else? Indicators.
Yeah, they can help confirm. Check momentum indicators. RSI, for example, ideally, it shouldn't be too overbought yet, maybe still below 70. And MEXED, you might look for a fresh bullish crossover around the time of the breakout.
So Nifty punches through, say, 22,500.
Mm-hmm.
Volume's up. METC looks good.
Tempting to jump right in.
Patience. False breakouts are super common. The price pops above the line, sucks people in, then reverses sharply.
Right, the dreaded fake out. So wait for confirmation. Definitely recommended, especially if you're more conservative. Confirmation could be a strong close above the trend line at the end of the trading day.
Not just an intraday poke.
Exactly. Or even better sometimes, wait for a retest. The price breaks out, then pulls back to touch the top of the trend line it just broke.
Testing it as new support.
Yes. If it holds that level, maybe forms a small bullish candle there and bounces, that's a much stronger confirmation. You can use things like Fibonacci levels or prior price points to identify these potential support zones near the trend line.
Okay, and you mentioned ADX before on the 19th, I think. Does that fit in?
It can. If ADX is rising and maybe above 25, it suggests the trend, either the old one resuming or a new one starting, has strength behind it. Adds another level of confidence.
Retest bounce seems like a solid entry signal. So confirmation in hand, how do we actually structure the trade? Entry, stop, target.
Okay, entry. Aggressive traders might enter on the strong close above the line. Conservative ones wait for that successful retest bounce.
Makes sense. Stop loss. Where does that go?
Crucial, it should go below a logical support level. That could be just below the trend line itself or perhaps below the low point of that retest bounce. The idea is if the price falls back below there, the breakout thesis is likely wrong.
Protect your capital.
Always. Consider the Nifty's average true range, its typical daily volatility, when setting the stop distance. Don't put it too tight, or normal noise might stop you out.
Okay. And targets. How high could it go?
Several ways to estimate. You could measure the height of the preceding correction, the distance from the peak to the low before the breakout, and project that distance upward from the breakout point.
Like a measured move.
Yeah, or use Fibonacci extension levels based on the correction, or simply target the next visible resistance level on the chart, maybe a previous high, which we talked about identifying around April 13th.
And the key is risk reward, right?
Absolutely. Aim for a potential profit that's at least twice your potential loss, a 1 to 2 risk reward ratio, minimum. If you can't find a logical target that offers that, maybe skip the trade.
Risk one to potentially make two. Got it. Now, actually doing the trade. Futures, options, ETFs.
Depends on your style and capital. Nifty futures offer direct exposure and leverage. Options, like buying a call option just above the breakout price, say a 22,600 call, can limit your maximum loss to the premium paid.
Less risk, but time decay.
Right. ETFs like Nifty Bs are simpler, tracking the index directly, less complex than futures or options.
And position sizing. How much capital to commit?
Keep it disciplined. As we discussed, maybe risk only 1% or 2% of your total trading capital on any single trade. That prevents one bad trade from hurting you too much.
Good reminder. So you're in the trade, then what? Just sit back.
No, active management helps. Consider a trailing stop loss. As the price moves in your favor, you move your stop loss up to lock in profits or reduce risk.
Oh.
Maybe trail it below recent swing lows or use a moving average. And have clear exit rules. Either you hit your price target or maybe the upward momentum starts to fade significantly. Don't just hope.
Plan the exit. Okay. What are the main dangers? What makes these fail?
Well, the false breakout is the big one. Watch for that volume drying up after the initial break, or the price struggling to move higher. A sudden spike in the VIX, maybe back above 20 like you prefer to avoid, is a warning sign.
Increased fear.
Yeah. Also, keep an eye on the external factors. Unexpected bad news globally, a surprise RBI announcement, heavy selling by FIIs. These can derail even a good technical setup.
So if the Nifty breaks out but then dives back below the trend line, especially with heavy volume.
That's usually a clear signal the breakout has failed, and it's time to reconsider or exit the position.
Okay, so let's recap the essentials. You need the clear uptrend first. Then spot that descending correction line with multiple touches. Look for broader market support and check the VIX isn't too high.
Right. Then watch for the strong candle and volume spike on the breakout.
Wait for confirmation of strong close, or better yet, that retest holding support. Plan your entry, your protective stop loss below support, and your target with at least 1.2 risk reward.
Choose your instrument, size your position appropriately, 1-2% risk, manage the trade with maybe a trailing stop, and know your exit triggers.
And constantly watch for failure signals like low volume post-breakout, VIX spikes, or the price falling back below the trend line. Plus, keep tabs on Nifty specifics like global Qs, RBI, FII flows.
You've got it. It's really about putting all these pieces together, the pattern, the context, the confirmation, and the plan.
It's fascinating, really, how a pattern on a price chart like that interacts with all those bigger forces, economic news, investor sentiment. It really makes you think, doesn't it? How might this whole breakout and confirmation process look different on, say, an hourly chart versus the daily chart we focused on? What counts as confirmation might change quite a bit, something definitely worth pondering. Thanks for breaking that down.